Today I'm featuring a video clip from Nouriel Roubini, and he talks about what he wrote about in his book, the Megathreat to the financial system, and expands upon it in the view of Silicon Valley Bank, Signature Bank, etc. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is April 4, 2023. Nouriel Roubini is professor emeritus at New York University, professor of economics, and he has his PhD in economics from Harvard. He's an esteemed economist recognized throughout the world. He talks about the things that he expanded upon in his book, the mega threat in the financial system. He wrote the book before Silicon Valley Bank crisis, etc., and he talks about it from two aspects. One, the amount of realized losses, and we saw this from Silicon Valley Bank. The amount of unrealized losses is today over $600 billion, almost 2/3 of $1 trillion of losses on the books of banks. These are both big banks and small banks, regional banks. They consist of losses from purchases of treasuries and mortgage-backed securities when interest rates were low, and then as interest rates rose, the value of those bonds and mortgage-backed securities declined to the extent of $600 billion plus. They also made loans on homes, that fixed rate loans at, let's say, around 3% when mortgage rates were in that area, maybe a little lower. And then as mortgage rates rose, they were locked into those loans. Nothing wrong with that, except now they have a subpar rate of return, and they need to pay a certain amount of interest to their depositors, and they're stuck with these low interest loans. So in other words, they've got themselves in a box. I'll let you listen to Nouriel Roubini. He speaks, in my opinion, with a lot of authority. Take a listen.
This seems to be something that's incredibly elementary. Your incoming freshmen at NYU already know that when rates go up, when the yield rises, the price of the bond assets falls. Is that the simplest explanation for what happened in terms of the banking crisis here in the U.S.? And were these just idiosyncratic problems with bank managers that didn't know what they were doing?
Yes, it's a good part of it. Both bank managers, regulators, and investors forgot about duration risk and market risk. When yields are higher, the price of the bonds is lower. Investors lost 20% last year on 10-year treasuries. The S&P 500 went down only by 15%. And for the overall U.S. banks, you have about $620 billion of unrealized losses on the securities out of a capital of $2.2 trillion. And for some of the regional banks, the number are much higher. But it's not just the securities have lower value. Many of the banks had issued loans like mortgages at fixed rates at 30%, 30 years, when interest rates were 1%, while right now there are 3.5 for 10-year treasuries. So the market value of those assets is also down. People have estimated, therefore, the overall losses for the U.S. banking system for the rise in interest rates, both on securities and loans, are equivalent to $1.8 trillion out of a capital of $2.2 trillion. Hundreds of the smaller banks are literally insolvent. So that's the fundamental problem. When interest rates go higher, the value of securities and loans is lower, and then we have mass liquidity and solvency problems.
Your recent book was called Megathreats, 10 Dangerous Trends That Imperil Our Future, and I wonder if this is among them. Interest rates at 5% or even 6% don't seem like a mega threat. We've had rates as high as 20% in recent history, in the early 80s. But we have so much more debt now than we did back then, which means carrying costs are much more painful. Is this higher rate regime a mega threat, Nouriel?
It is because in the 1970s, when we had the stagflationary shock that led to inflation and recession, debt ratios in advanced economies were only 100% of GDP, private and public debt. Today, there are 420. So we have the worst of the 70s in terms of negative supply shock, reduced growth, and cause inflation, and we have debt ratios that are much higher than after the GFC crisis. And during the GFC crisis, we had the debt problem, housing debt, mortgages, bank debt, but we had negative demand shocks and a credit crunch that led to deflation, so we could do massive monetary, fiscal, and credit easing. Now we're entering a recession and financial instability, having to raise interest rates because the inflation is too high. So we get inconsistency and a trilemma. We cannot achieve price stability, maintain economic growth, have financial stability at the same time. So eventually we'll have an economic and financial crash.
Next, I want to play for you a brief clip from an interview of Jonathan Ferro from Bloomberg, the interview he had with Bill Dudley. Bill Dudley was the former president of the New York Fed, and he explains that the issue is that, yes, there are losses in securities, which we just heard about, but there's also going to occur, already happening, a tightening of credit. When there's a tightening of credit, meaning companies usually are having to borrow, maybe they don't qualify now because the standards are stricter and, of course, the rates are higher. So he believes that this will result in a hard landing and that this will result in a picture that was worse than it was before the Silicon Valley Bank debacle. So take a listen to Jonathan Ferro and Bill Dudley.
Bill, you've had some time to process all of that. What do you make of it?
I think it was pretty logical what happened. Basically, the Fed is saying that, one, uncertainty has gone up a lot. We're not really sure how long the banking system stress is going to last and how severe it's going to be. Number two, that stress is going to restrain the economy, and that substitutes a little bit for rate hikes. So we're not going to have to do as much as we thought we were going to have to do earlier. But I think the real key is something that Mike McKee talked about. Uncertainty has gone up. Uncertainty has gone up a lot. And I think it's sort of interesting that markets are not really fully focused on that, because the risk of a hard landing is higher now, because the Fed isn't going to really know what's the appropriate policy to do until they get a lot more information. And it's going to take time for that information to be received. And it's not going to be very easy to assess how are these banking woes going to affect credit conditions and how much is that going to affect economic growth. So I think that we're actually in a worse place today than we were a few weeks ago, because there's two forces. One force is keeping inflation high. Another force is slowing the economy down. And we don't know which one is going to dominate or for how long. So I think the risk of a hard landing has definitely gone up.
Bill, the easy way to dismiss any conversation around the Fed is just to say they're data dependent. I hear that so much. They're going to be data dependent. But Bill, at this point, I'm wondering, what data are they dependent on for the next decision?
Well, I think the problem is that the data on the effects of credit tightening on the economy take a while to actually be realized. We have two sort of open questions about the banking system. Number one, how broad is it going to be? How many banks are going to be affected? Number two, how much are banks that are affected actually going to tighten their credit standards? The problem is not a credit problem. The problem was actually banks taking on too much interest rate risk. So it's not obvious to me that tightening credit standards is really the logical response. And number three, how long is this going to go on? So I think that there's a lot of uncertainty here about how much of a braking effect the banking system woes are going to be on the economy. The fact that the Fed basically has one more rate hike and then keeps rates high throughout the year suggests that at this point, they don't think that this is going to exert a lot of downward momentum on the economy. What's interesting today is the market reaction to the Fed's press conference and the statement and the summary of economic projections was to be ever so slightly surprised by the rate hike because it wasn't fully priced in. But it actually is pricing in more rate reduction in the rest of 2023 and into 24 than they were earlier. And I think that was a little bit surprising, frankly, given the fact that Powell was very clear. We don't expect to cut rates in 2023.
Next, a clip from CNBC. Steve Leisman makes the point that the amount of money that is flowing out of banks, both big banks and small banks. See, what some were saying was that the money's flowing out of small banks and big banks are the beneficiary. Not so on a net basis. Money is flowing out of both of them into money market funds. And there is a credit tightening which is occurring, and this will probably be the result of Fed hikes. So you've got Fed hikes, and you've got interest rate hikes, and then you've got credit tightening. Either or both will lead to a weakening economy. Take a listen to Steve Leisman.
Breaking news on the Fed. Steve Leisman has the details. Hi, Steve.
Hey, Morgan. We have data on what's happening to deposits at banks in the United States, which we've been watching to see if this issue of whether or not money is flowing out of large banks or out of small banks. What we found is that deposits at domestic banks actually declined $97 billion to $16.09 trillion on a not seasonally adjusted basis. You did have an outflow from the large banks as well, 96 billion down on the large banks, and that was to 10.7 trillion. And the outflow from the small banks, those are the large banks are the ones, the top 25. The small banks are just down by $1 billion to 5.39. Now, they did take a big hit the week before, down 184 billion, but at least for the week, that seems to have stopped. At the same time, you still have this exodus from the banks in general, and maybe that money is flowing to money market funds for higher interest rates, maybe into treasuries. Hard to know right now, Morgan, but you do have this exodus from domestic banks in general, with the bulk of it coming out of large banks, and the flow from small banks down to just $1 billion after 184 billion flowed out the prior week. Morgan?
Okay. I was going to ask you that if there's any sort of sense or intel in terms of where some of that money is going, for example, money market funds or treasuries, as you just mentioned. You take this data, which we're now following on a weekly basis. You take the Fed speak we've been getting all week, including with John Williams just this afternoon talking about the state of credit and the fact that that seems poised to continue tightening and help the Fed do its work for it in terms of this fight against inflation. Where are we at in terms of the banking picture, especially as we do start to think about earnings in a couple weeks?
So I'm sorry if it's a bit of a cop-out, Morgan, but it's early days. And I think that was best exemplified by what John Williams said today. He said he has concern about this, as other Fed officials have as well. But they don't know the extent of what's going to happen here. There is an issue of credit tightening, and whether or not credit tightening takes the place of interest rate hikes. I'm not sure, though, Morgan, I think this is something to ask our esteemed analysts, whether or not that's the kind of trade-off that's a positive trade-off. It's like, hey, they're not raising as much, but hey, they're not raising as much because banks aren't lending, inflation is falling because overall economic activity and investment is falling. So I'm not sure that's the rosiest environment, certainly not for all stocks, maybe for some select stocks. And while you were asking the question, I did pull up the money market data, which we got the other day, Morgan. 65 billion flowed into money markets to a record 5.19 trillion. And that's after, I'll tell you the total over the last 3 weeks of data, $304 billion has flowed into money markets. So that's people saying, you know what? I'm not earning nothing on my bank account. I can go over here to money markets. Now, of course, those are not insured deposits. At the same time, the liability side on that deposit, the asset side on that deposit are short-term money market, short-term government T-bills, usually all short-term paper. So people have a sense of security in those money markets. But again, they're not FDIC insured.
That's a key point to make, Steve Leisman. Thank you.
Now I'm going to shift away from the economy over into the stock market. Joe Kernan interviews Megan Horniman from Verdance Capital, and she says that kind of makes the same point that Mike Wilson made, which I played in previous sessions numerous times, that we are going to probably experience a decline in the stock market in the short run, but following that will be a stock market rally. I've played numerous people over the past few months who have been saying the same thing. The question is when. We don't know exactly when, but if I were to kind of read between the lines here, I'd say sometime within the next few months, we're going to have, and could be even this month, but I'd say sometime in second quarter, it sounds like we will have a decline in the stock market. She says, maybe it's 10 to 15%, but it could be as high as 20 or 25. But somewhere in that double-digit range, we'll have a decline. I would not call it a collapse, but it will catch some by surprise. Following that, the further down that is allowed to go, and at least on an intermediate term basis, hit a bottom. Even if it's an intermediate term bottom, if it's allowed to do that without being propped up, it has an opportunity to accelerate perhaps during the second half of the year. Take a listen to Joe Kernan and Megan Horniman.
Right. If there's a credit contraction, we just maybe earnings estimates still haven't come down enough, and that could introduce, I guess, some risk to where stock prices are. But then I can argue this. I can argue that maybe one of the reasons that technology has been outperforming is because rates might not go up as much, and therefore what you lose in earnings, you might gain in not having multiples contract as much. Why do you think technology has been outperforming for the past month?
You mentioned it. Interest rates are lower, and the expectations, even if the Fed goes another 25 basis points, which we still believe that they need to and that they will, their market's pricing in rate cuts as early as the second half of this year. I think that's way too optimistic considering where we are from an inflation standpoint. That's why tech's rallying, and we've seen these spurts in technology over the past year. When interest rates decline, these large cap tech, mega cap tech stocks go up. And then you do see that kind of lose its luster when people start to get a little bit more realistic where the Fed can go and where they will go.
So inflation's going to stay stubborn, and the Fed is, they don't want to make another mistake in terms of underestimating something like they underestimated inflation. So they probably are going to be very hesitant to not get the job done here. What does all this say to you then about the averages? That they stay in a trading range, or do they go to new lows?
I think in the near term, and I'm not saying over the next couple days, I mean, remember it's month end, there's a lot of things going on, but I think in the near term, the direction for stocks is lower. I think at least a 10% correction from here is probably likely. And then I think what we can see is after the Fed gets past that last rate hike in May, they're going to be on pause for a long time. We get through this banking crisis. We will start to absorb some of the downside from an economic growth standpoint, but we will be looking at what could be a very nice bull market coming out of this once we start to see inflation come down as well.
And finally, I want to play a piece from CNBC with Sarah Eisen interviewing Dan Suzuki from Bernstein Advisors. What he speaks about is the sort of the same thing, that coming up, we're going to have a decline. And he says, especially in the tech sector, because it is so overvalued and people are not expecting this. So sometime in this quarter, second quarter, and then following that, be a period of acceleration and stock market values going up. The point he makes, and this is a good point, and that is time horizon. When people talk about the market declining or collapsing, are they speaking of this month, this quarter, this year, sometime in the next 5 years? If you could include all of those scenarios, you could say, sure, it's going to collapse, and you'd probably be right. And if you said, and it's going to accelerate upward, you would probably be right. It'll be some combination of that. So it depends on what time period you're speaking about. So when I think in terms of the market declining, let's just say 10 to 25%, I think of that during the coming months. Maybe it's the second quarter, maybe it's even the third quarter. And then at some point, when it hits a bottom, at least an intermediate term bottom, it will accelerate, as I've said before. So take a listen to Sarah Eisen and Dan Suzuki.
So investors may want to pull the plug on the big tech trade. Our next guest says the bubble in the sector will start deflating again in Q2. Dan Suzuki is the Deputy Chief Investment Officer at Richard Bernstein Advisors. The firm made its tech bubble call almost 2 years ago. Dan, then it popped and you guys were looking smart. And now, what do you think is happening?
Not so smart anymore? Yeah, I think this is to be expected. I mean, if you go back to the last tech bubble we had, you had 16 different double-digit rallies over that 2.5-year period, while the Nasdaq was falling over 80%. This is to be expected. People don't give up the stuff that they've known to come and love that dominates their portfolios, where you're sitting on tons of capital gains still. So I think they're going to fight that. And I think Tim said this. You know, the fact that people want to just go back and own the stuff that's worked over the last cycle tells you a lot about where sentiment is. People don't want to go where the future leadership is going to be, which is not where the bubble is. That bubble is still deflating.
And when you say bubble, you're putting the mega caps in there too? NVIDIA,
oh,
Microsoft,
absolutely.
Apple, all the leaders.
Yeah, I'd say if, you know, the leadership of the last 10 years was really driven by U.S. large cap growth, U.S. mega cap growth, however you want to define it, innovation, technology, all that stuff is still, you know, includes the mega caps for sure.
So if that's the old where you wanted to be, what's the new where you want to be? Where's the puck going?
Yeah, well, if we're right and there's a bubble that's still deflating, I mean, if you just think about what a bubble is, it's a giant vacuum for capital. So you get this massive misallocation of capital into one area of the market. So where's the big opportunity? Where capital is scarce, which is pretty much everything else. If you take out those 3 sectors in the U.S. that are dominated by technology, I think everything is fair game. Probably not. Defensives probably aren't going to be the leadership of the next cycle, but everything else. So that's international, that's small cap, that's value, that's pro-inflation assets. No one wants to own that stuff because it's underperformed for a decade or two. That's why it's so cheap, and that's where the opportunity is.
I think you've got a story to tell around rates peaking, the dollar possibly peaking. So are there places for investors to chase? Chase is maybe the wrong word. I'm actually saying invest in companies that are generating free cash flow, that are growing their payout ratios in an environment where I don't see how the dollar can move significantly higher. I'd argue that's an 11-year bull market in the dollar. Rates, I don't think, can go a lot higher. I mean, this is a backdrop for some companies to perform.
Yeah, absolutely, Tim. I think you're right here. You really have to separate the next 5 to 10 days, next 5 to 10 months, next 5 to 10 years. The next 5 to 10 days, I mean, what's working is probably going to continue to work. I mean, there's probably some room for, you know, a rally and this stuff that's beaten down. You know, 5 to 10 months, I think the key story is that growth is slowing. Profit, you know, we're going to go into earnings season. This earnings season is probably going to be worse than last earnings season. So the companies that are most sensitive to that slowing growth, they're going to probably get hurt by that at some point. But next 5 to 10 years, that's the stuff I was talking about, where the big opportunity is for the long term. So it depends on what your time horizon. It's very different what you want to own. And I think along the way, there's attractive companies that are going to benefit from each one of those dynamics.
So we heard from all the way back to December. I think it was the December 13th video that I did where I featured Mike Wilson. And he was talking about what they understand at Morgan Stanley as the earnings projections for the first quarter, which start getting announced during the second quarter, probably about the second week of April is when they start being announced. And that his belief, based on the calls that they've made to companies, that they are expecting a downgrade in their earnings and earnings forecast. And that's what this chart shows. This shows that and I got this off of Bloomberg, it came from Citigroup and Bloomberg, and you can see these are weekly bars, that the expectations is that earnings will be downgraded, and you look at the last couple of weeks to the far right, and you can see that the projection for stocks being downgraded is greater than the weeks before that. So this is, the market gets ahead of itself. So there's been a desire for enthusiasm, and stocks are starting to go back up, which they certainly have done during the past week or so. But I think based on what Dan Suzuki said and Mike Wilson has said and others, that it's it tries to get ahead of itself, and so there is going to be putting a greater degree of pressure on maintaining that, and if there's earnings are downgraded, that has a chance particularly tech stocks, have a chance to decline during the second quarter, maybe the third quarter. This is a chart showing the interest rates that Mexico and Colombia have. So they're at 11 and 13%. 11 Mexico, 13 Colombia. Now you could say those are developing countries and you could dismiss them. Okay, I accept that. But they're still somewhat major countries, population, way into the millions. And so what that tells you is that they're experiencing very high inflation. It also tells you when interest rates are that high, what's going to happen to them is the same thing that would happen to us with rate increases, and that is a collapsed economy. Now, we can't just isolate Colombia and Mexico and say, that's not us, that's them, because it's an indicator of a broader problem, a broader and more systemic problem. So, but the magnitude of it is what caught my eye, 11% and 13%. This morning in Bloomberg, I was reading and saw this. It was very shocking. So I remember I was in Seattle at the time, the amount of office vacancies during the housing financial crisis, I guess they call it the Great Financial Crisis, the offices that were vacant during that period of time. I also remember back to 2000 to 2002, the amount of office vacancies. And this chart is of San Francisco. So this shows, this chart goes all the way back to 2000. So it shows the amount of vacancies, I think it's a yearly chart, that in San Francisco, the current office vacancy is 30%. 30% higher than any time in the past 23 years. I think you probably could go back 30, 40 years, and I don't think you'd see vacancies at that level of 30%. Could be several reasons, and I think it's a combination of these. It could be laid off workers. San Francisco, even the city of San Francisco, is very tech centric. So laid off workers, we know there's been about 300,000 laid off workers in the tech industry, and a good portion of that, or some portion of that, is in San Francisco. So laid off workers, work from home, and companies going out of business. A number of tech companies because of the Silicon Valley Bank issue, but other issues is that the industry has become sort of bloated, and that's showing up in real estate. This probably also follows, has an impact in other cities like Seattle or Austin that are also very tech heavy. But this one relates to San Francisco. I just thought it was interesting from the perspective of the historical pattern. When you go all the way back to the first three bars in that chart on the left side, that was the tech bubble crash. Look at where it is now compared to that. Even in the housing crisis in 2008, 2009, look where it is now compared to that. So there's a sort of a crack in the foundation that's occurring. And I don't know if you see this where you live, but I would say, and this relates to office buildings, not necessarily to housing, but it's an indication of a downturn and a headwind for the economy. When I put my, I do my broadcast on YouTube, people comment. So I did one a few weeks ago, which was on Simon Hunt and his forecast. It was kind of a longer term forecast, forecasting the coming year or two, and then in 2025 that this would result eventually in a global depression. And I got a lot of comments on that. One of the people who commented, I thought I'm going to read you this because I thought she did she took the side of, instead of saying, if we enter a period of collapse, And we don't know. I mean, I think eventually we will. I don't know when that'll happen, but that would not surprise me. I don't think it's right around the corner, but at some point, I think there's so much excess in the system that certainly could happen. But she said her approach was, instead of seeing the negative side of this, she said there's actually some good things that come out of this. Now, if you were to just imagine that we were going into a depression, that means 10 consecutive quarters of contraction. That is a harsh period, and we have not been there since the 1930s. But if we did, the things that I've said to people is be prepared to be defensive in your investing approach, and have some physical silver, or you could even have physical gold as a counterbalance to the buying power of the dollar. Nothing wrong with that. Taking some money out of taxable assets to buy some physical gold or silver. But her approach was to just think of the result of this. And so this is different because we've never, in our lifetimes, we've never gone through this. And so because we haven't, we don't know what it's like, and we don't know what assets are going to be good, what prices are going to be, unemployment, housing, what's it like to shop? Are we going to be at a barter economy? We don't know any of that stuff. So, because it was much, much different 100 years ago. But this is what she wrote, kind of looking at the good side of a depression or a very, very harsh economic environment. And I won't say that I agree with everything here, but I just thought it was interesting to take the perspective of, let's look at the positive side. And she said, and I'm just going to read you what she wrote. She said, I'm a fairly positive person, so here's some good things which could come out of this. Number one, a sense of community will return, which we generally don't have right now. People come together to help one another. 2, useless jobs and corporate bureaucrat positions will be cut. Companies will value experience and work ethic. Number 3, return to the gold standard. With BRICS, BRICS means it's an acronym for the countries of Brazil, Russia, India, China, and South Africa. With BRICS in the talk of establishing a gold-backed currency, the only solution to combat this is a gold-backed currency in the U.S., as the fiat currencies around the world will all collapse. Number 4, family businesses and home ownership will once again be favored. 5, the U.S. will no longer be attractive for foreigners, and immigrants will return to their home countries. Number 6, house prices will decline, and wages will go up relative to the new gold-backed currency. In other words, whatever you're making, what value is that? What is the buying power of whatever you're earning or the assets you have relative to the prices that you can buy them for? So they can change position quite a bit. So you may have less, but the value, the buying power is greater. Bad news for big corporations, good news for young people and family businesses. Anyway, I thought that was interesting. Thought it would end on a positive note because I know I deliver a lot of news that's sometimes negative, and I'm always looking for something that could be positive out of it. So there you go. If you have questions or comments, leave them in the comment section below, and I will try to answer them. Thank you for watching.